Welcome to Killik&Co's podcast for the 10th of June. Last week we enjoyed quite a rollercoaster ride with stock markets around the world. We'll take a look at a few of the charts to summarise the performance during May, but clearly we've been seeing some pretty key trend changes last week. The question on everyone's mind is, are these changes in for permanent, or will they prove to be a pullback in an upward trending market? But let's start with taking a look at the diary for this week, and I will summarise to say that in terms of anticipated news, it is going to be a much quieter week. We look forward to certainly fewer corporate results than has been the case. Certainly a couple of that will stand out for us include Yum Brands that report monthly sales on Tuesday. But in terms of some of the economic data that's been driving markets, particularly through May, the US PPI data that due out on Friday, and some confidence statistics out on the universities. So as an overall picture, I would guide you towards having less volatility around economic data than we saw last week. Now, just a quick summary of last week. In terms of the data that we saw, we were getting better data out of Europe, in some surprising data actually from Spain, which was looking at manufacturing and service forward indicators coming in much better than expected. But really all eyes were on the jobs data from the US, and that number came in as a strong number, but not too strong to concern the investors in bonds that have endured quite a volatile month, that the economy was strengthening, and that tapering of QE would be something that would happen sooner rather than later. I think the number was pitched about perfectly for a continuation of QE, but not a deterioration in the economy. So let's just take a look at some of the charts that were relevant for the week. Going to start off with the FTSE 100, and this is the chart purely for May. Really what one wants to try and do is just to summarise that the first half of the month we saw the markets hit the high for the year, but really since that period of 22nd of May, we've seen quite a sharp retraction in equity prices, getting as far back as 6,300 with a bounce. So of course over the course of May we've seen the market lower, but trying to get to a period of stability towards the end of the month. Let's just put that chart in some context over the course of the year. This is the year-to-date chart for the UK index. So at the peak we were probably up around 16%, and we've given up around half of those gains up to date, back into the sort of mix at the moment. The story is pretty similar elsewhere. Japan, this is again the month of Japan, and very similar trends that we saw in the first half of the month. The pullback in Japan being much more significant and much more volatile, but again putting it into the context of a year chart, we can see that the rise was significantly higher, and that pullback would reflect the level of gains that have been taken during the course of the year. Importantly, we did see a good performance overnight from Japan, up around 5%, and that was being driven somewhat by the growth statistics that were brought forward, showing that growth in Japan was annualising at around 4.1%. So that's better than 3.5%. So I think overall as a picture, whilst it's a brave call in the face of such volatility at the moment, the sort of underlying picture of health within the US and Japanese economies at the moment remains sort of sufficient to at least allow continued QE to remain, but at the same time no particular signs that economies are falling off a cliff. And I think should give heart to markets that after a bout of volatility we could be heading back into a more stable period for equities over the course of the next few weeks. In terms of the currency situation, really for me, just keeping an eye on the euro. Euro strengthened last week. We heard from the ECB along with the Bank of England. They weren't going to change rates. They weren't going to change anything on the stimulus side for the ECB. They would have taken heart, as I mentioned, from the data that was coming out from Spain, indicating that whilst still in contraction, it wasn't as bad as feared, and so that has certainly helped boost the value of the euro on the expectation there'll be no early move to follow up on that last month's rate cut from from the ECB or indeed any other policy actions there at the moment. So that's obviously bullish for the euro and has taken a little bit of steam out of the dollar, which was getting quite strong towards the second half of the month. Now, what's been driving this volatility in equity markets during the course of May really, I think, was driven by this the 10-year sort of yields on the US Treasuries. As we can see, around about that early May period, it followed a period where yields contracted very, very sharply in the US region, and we saw this turnaround, which was being driven by stronger data emerging from the US economy, which took yields up from a low of 1.6 up to around 2.2%. And my argument here is that as most other asset classes are priced off of the 10-year treasuries at the moment, the rise in yields that we saw over the course of the month started to take some of the attractions away from equities on a relative basis, and this, I think, remains pretty much the pincer movement in equity markets at the moment. Now, so this is the chart that we'll be watching quite closely over the course of the next few weeks to see how that, if that yield were to push higher, I suspect it would continue to compress equity valuations in the near term, but one to watch quite closely. Again, just in terms of yields on not just the safest US markets, but this is the yield in Spain as well. We've seen everything that's priced off the US Treasury reacting in similar ways. So the yields on Spanish 10-year have been moving higher. So having got down to a low of around 4%, we're pushing up to around 4.5%. So again, very similar themes here as yields begin to rise in bond markets, possibly indicative of slightly stronger times ahead. Tapering of QE relief. It is at the moment just acting as a little bit of a weight on equity valuations and creating the volatility we have seen. I don't expect it to run too far, and hence the reason why I think that the uptrend in equity prices remains intact despite that pullback that we have seen. Just finally, on a few equities I want to highlight, we had results out from Tesco last week. We have seen quite a sharp pullback in Tesco shares. No question that there is overcapacity in the UK market. They're having a few problems in the international markets at the moment, which are quite clearly causing some concern at the moment. But how much of it has been priced in? We're putting a trading buy note out on Tesco for this week on the back of this pullback. And again, anyone would like a copy of that note, it's through the usual sources of your broker. Rio Tinto, again highlighting that to the course of January, the stock is down around 20%. This is a sort of classic barometer for the mining sector. It's the mining stocks that have suffered most during the course of the first half of 2013. Just observing that there's no real bounce we're seeing at the moment. Rio Tinto this morning are down and touching those sort of lows that we've seen during the course of the year. So we've got no evidence yet that that particular trend is bottoming out at the moment. But it is one to keep an eye on because the stock markets around the world are going up, really based upon sort of hopes that if not an economic recovery, we've got stabilised economies, that one hopes that will start to filter through into the commodity space at some point. So again, it's not necessarily a buy yet, but one which we're watching quite closely. Finally, just to mention for the utility space, Severn Trent, they have rejected the higher offer from the consortium of £22. As a result, the consortium have said they're not putting forward any further proposals. So we have seen the shares react about 5% down to £19.90 this morning. I have been slightly fearful that as bond yields have been rising, that utility stocks have become slightly less attractive in that environment. So we've seen other utility stocks like National Grid coming off quite sharply. Severn Trent held its rating, obviously because the bid talks were there, and we thoughts of a higher bid. But if they do walk away, there is thinking in my mind that Severn Trent may well see just a little bit further retracement back into that sort of £18 region that it was trading at prior to the bid talks. So again, one to watch there at the moment. Obviously a risky call, telling people to come out when there could always be potential bid action, but as I say, the consortium as of Monday morning look like they're walking away from that particular bid.